Hi, this is Anil from Pristine. In today's class, we'll talk about bond valuations in fixed income securities. This topic of fixed income carries a weight of around 12% in CFA Level 1 exam, and from this particular subject, you can expect around 2 to 3 questions in the exam. So, in today's session, we'll particularly focus on how to value a bond and what are the three different kinds of bond in terms of prices. So the valuation of a bond is just the present value of all the cash flows from the bond. So if I have a bond of say 10 years maturity or say 5 years maturity, and we are at this particular point, so this bond will give me some cash flow within this period and a lump sum amount at the maturity. So these intermediate cash flows are called as coupons, and this lump sum payment carries the face value plus the coupon. So whenever we say what is the price of the price of the bond is just the present value of all cash flows. So we know that after 1 year or after one period, we have a cash flow of C1. After 2 periods, we have a cash flow of C2. After 3 periods, we have a cash flow of C3, and so on. And the discount rate used for the prices would be the yield to maturity. Okay, so this is the yield to maturity. So if I discount all the cash flows with this discount rate, I will get the price of the bond, right? So the price can take 3 different stances. So we have the face value, right? Face value. The prices can be above face value. Prices can be equal to the face value. The price can be less than the face value. So if the price is equal to the face value, we call that bond as a par bond. If the price of the bond is greater than the face value, we call that as premium bond. And if the price is less than the face value, we call that bond as discount bond. Now, if the prices follow this particular relationship, we know that there has to be a relationship between the coupons and the yield to maturity or the discount rate. So if I'm saying that the par value or the face value of the bond is equal to the price, that means that the coupons would be equal to the yield to maturity. So whenever I'm saying coupons here, so this means this coupon is in percentage terms of the face value. Now in a premium bond, the coupons, which are the numerators, has to be greater than the yield to maturity. So again, this is in percentage terms. And for the discount bond, the coupons has to be less than the yield to maturity, right? We'll see an example after some time, but before we actually go to the example, let's see how the prices of these bonds changes with respect to time. So here I'm assuming there is no change in the yield to maturity or the interest rate in the market. So suppose I have a bond of 10-year maturity. In the case of a par bond, as the time passes, the price remains fixed if nothing is changed in the market. So if the interest rate scenario does not change, the par bond prices will remain at the par. That is, the price of the bond throughout this period, throughout these years, these particular years, will remain the same. So with respect to time, it would be a straight line parallel to the x-axis. Now in the case of premium bond, if we see at t equal to 0, the price of the bond is somewhat greater than 100, right? So that's why we call this as a premium bond. But as time passes and the interest rate scenario doesn't change, the price will start converging towards the face value, and at the maturity the price would be exactly equal to the face value. All right. Similarly, in the discount bond, it will start from a lower end. That is, for a discount bond, we know that the prices are lower than the face value, so it will start from the bottom and it will start increasing, and finally at the maturity it will converge to the face value of the bond. So this particular concept, where at the maturity the prices of all the bonds converge to the face value, we call this concept as pull to par. So with respect to time, the prices are pulled towards the par value or the face value. All right. So on this particular concept, let's solve a question. So it says, consider a 5-year vanilla bond with a face value of $1,000. So the face value we know is $1,000, right? And the coupon is 10%. Calculate its price if the interest rates are 9%, 10%, 11%. So we have three scenarios for yield to maturity. So yield to maturity is 9%, we have 10% and 11%. So we know that whenever yield to maturity is less than the coupon, the prices has to be greater than the par value. So in this case, the price would be greater than 1,000, and whenever the yield to maturity and the coupon is same, we know that the prices are equal to the par value, so this would be equal to 1,000. And in the last case, the prices has to be lower than the face value because the yield to maturity is more than the coupon percent, right? So this becomes a premium bond, this becomes a par bond, this becomes a discount bond. So let's go to the options now. First says a premium bond, second is par bond, third one is a discount bond. So it seems to be correct, but let's go to the other option. Again, premium, par and discount, and similarly premium, par and discount. So all the three options can be correct. So let's solve the questions now. So using your TI calculator, TI BA2 plus calculator, so we have 5 keys that are required from the second row of your calculator. So N, I by Y, the present value, the payments and the face value. So let's put these values. So N is 10 here, it is 5 here, 5 years. I by Y, that is the interest per period, is in first case is 9%, right? Present value we need to find. What is the payment? The payment is the dollar cash flow during the within the period. So these are the dollar coupons. So coupon is 10% of 1000, which is the face value, so it becomes 100, and we have the face value. So face value is 1000. Now calculate the PV from there. So PV in this case would be 1038 point something. So first one can be correct, second one can be correct. So we need to solve for the other case as well. So now put 11% here and find the price. You will get a price of $963. So the answer is A, right? So the answer is A here. The other way can be you calculate the present value of each and every cash flow. Okay, so we have 5 cash flows at t equal to 1. We have $100. T equal to 2, we have $100. T equal to 3, we have $100. T equal to 4, again $100, and at t equal to 5, we have $100 plus 100, which is the coupon. So 1100 in total. So calculate the present value of this cash flow using the interest rate of 11%, 10% and 9%. Similarly, calculate the present value using these 3 interest rates, present value of this cash flow, and so on. So the price would be the present value of all cash flows. I hope you have understood this concept. So let me quickly show you an Excel which does the same thing. So if you see here, the notional amount was 1000. In our case, the coupon was 10%. So dollar coupon would be 10% of the face value, which is $100. Tenure is 5 years. Okay. And in the first case, I have taken the interest rate to be 9%. So 9% is the interest rate throughout. So the present value is calculated here. Alright. So present value and sum of all this present values, all this present value would be the price of the bond. So it becomes 1038.9. So in our case, using calculator, we were getting 1038.9. Now if I change this interest rate to 10%, the price becomes exactly equal to the face value. And now if I change this interest rate to 11%, the prices will fall. So it becomes slightly lower than $1,000, right? Now if I plot this, on a graph, so the discount bond will start from here. Okay, it will start from here, and it would be always lower than the face value. And similarly, the premium bonds would be always higher than the face value. Now the important thing to note here is this is not with respect to time. Okay, so this is with respect to the coupon. All right. Now this is the summary of all the different cases. So what is the price when coupon is 6% and the interest rate is 2%? We know it has to be higher than the face value, so it is 1189. Now if you note this blue colored cells, you will see that the interest rate or the yield to maturity and the coupon is exactly same. So we are always getting a face value of 1000 as the price, right? And whenever the interest rate is more than the coupon, we know that the prices will fall, right? So that was about the Excel part. So I hope you have understood the concept. So in case you find any difficulty, you can write a mail to me at anil@eneve.com. Thanks a lot, guys. Thanks for listening, and I hope to see you around in the next class.